Barclays continues to dominate the headlines, and no one is exploring the myriad angles more than Reuters Breakingviews. Today I'm joined by Chris Hughes, and we will discuss what if Barclays had not lowered their Libor submissions and why Bob Diamond should forgo as much as £30 million in severance pay. Chris, what if Barclays had not lowered their Libor rates then?
Well, this is like a great thriller, you know, whether something happened on October the 27th or November the 3rd makes a huge difference to what happened. Now, of course, you know, we're talking here about fiction. We don't know what would have happened, but the timing is very significant because back in late 2008, you know, the markets were going crazy, and you know, these Libor rates were going up, and clearly the worry was that Barclays was an outlier and did it have some terrible funding problem. Now, if you recall, at that time, Barclays wanted to buy all of Lehman when Lehman went bust. It ended up buying only the US portion of that. Now, what if you know, these higher Libor rates, sort of honest Libor rates, had prevented Barclays from doing that transaction? It may have been seen as you know, rather than a sort of solid saviour, it could have been seen as you know, an incredibly risky entity, and you know, bulking up more in investment banking would not have been allowed at all by the regulators, and that was a massively strategically important deal for Barclays. It may not have happened if they'd have been posting honest Libor rates. Now, not just that, that was in September, of course. Now, when we get to the events that are in focus now around this key telephone call between the Bank of England Deputy Governor Paul Tucker and Bob Diamond, that was around this time when Barclays was under huge pressure from many within the UK government to take state capital, to effectively be partially nationalised, which obviously the bank really didn't want. And so at the time, they were Barclays was negotiating with Middle East investors to raise about £7 billion of capital there and stay out of state clutches. Now, again, what if the Libor rate had been higher? Would the Middle Eastern investors have maybe been scared off? In which case, Barclays would have had to go into government clutches. So, you know, we were all saying that the economic significance of this attempted Libor rigging may not be that significant. Well, it may not be actually in the markets. It may not have actually made a lot of difference. But strategically, to where Barclays ended up and what it avoided, it could have made a huge difference.
Possibly, yes. But I mean, other UK banks, I was looking at charts earlier this morning. The other three major banks, HSBC, RBS and Lloyds, at the time were all posting lower, much lower rates, Libor rates than Barclays. Of course, HSBC stayed out of government control. Didn't seem to do RBS or Lloyds much good.
Well, I mean, on RBS and Lloyds, of course, by then they'd already been the announcement of substantial state support and the state capital. So it could just be that the lower Libor rates there, sort of, you know, their submissions just reflected the fact that the market was willing to fund them at a lower cost because the market knew the government stood behind them. Whereas in Barclays' case, its destiny was still very unclear. Now look, it may have been, it made no difference at all. It may have been actually that the savvy people in the market knew full well that actually, you know, all the submissions are a little bit iffy, and that the smart money knew that actually Barclays could fund itself. But
well, perhaps we'll hear more from the man himself, Bob Diamond, when he testifies to the Treasury Select Committee today. And talking of Diamond, you argue that he should forgo any severance pay. The fact that he's in line for any severance pay at all may seem to a lot of people absurd.
Yeah, well, I'm not sure that he is actually. I mean, there is this number £30 million out there, and you can get to 30 million if you add up every potential bonus you could get in 2012, pension, salary, and then you put just multiply his unvested share awards by the current share price. You sort of get to 30 million. It's quite artificial. In reality, actually, I've just been looking through for my sins the annual reports and looking at the conditions here. It's not clear that he would actually be, even strictly on sort of straight contractual legal interpretation, that he would be entitled to that much. I mean, all the LTIPs are subject to even pro rata performance testing. I'm not sure that any of them would really be in the money now. Existing awards are subject to clawback. There are some which are just past bonuses paid in stock that he would have just got if he stayed. Like maybe he would get them, but they're only a couple of million. And anyway, our point is that even if he's entitled to a lot of money, he actually still has options in his career. He could go to the States and run a big bank, and if he was going to do that, he'd want to have good relations with the UK regulators. So buying a bit of goodwill by sacrificing what he is entitled to might create the conditions for him to get a big job in finance outside the UK, where he could earn way more than he'd be giving up. So rationally, he should probably, even from a financial perspective, he should probably say, I'm not taking it, and leave with his reputation partially restored and leave on good terms with the UK regulators, and then he'll be able to take a big money job elsewhere.
Doesn't sound like, though, given that memo that they published yesterday, doesn't sound like good relations with the UK regulators is a number one priority in his mind.
It's look, he is where he is, but no, this whole bonus issue provides him with a very visible and demonstrative way of making a sort of public sacrifice, even though, as I say, I'm not sure that he's entitled to that much anyway, but in the public perception, it'd be seen as though he was giving a bit back, and like I say, he could earn a lot more probably in the US, in a few years' time. And
by doing so, he may avoid taking Fred Goodwin's mantle of maybe public enemy number one.
I think that comparison is somewhat unfair. I mean, Fred Goodwin and the way he built up RBS. I mean, RBS really did. Nearly bring down the country. Barclays is still functioning pretty well. So I think
in terms of in the eyes of the public. Yeah, the unacceptable face of banking.
Even if you look at the way Bob's been described, there is recognition of what he built at Barclays, and clearly his wealth puts him in the firing line. But I don't think that I think there is some margin between him and Fred Goodwin at the moment still.
Okay, Chris, thank you very much. That's all for now. My thanks there to Chris Hughes. For more agenda-setting financial insight, watch our US Breaking Views show every day at 12:30 Eastern, 17:30 British Summer Time. I'm Jamie McGeever. This is Reuters.